Assalamualaikum and a very good afternoon, everyone. So I know it is lunchtime already, so I really appreciate that everyone is staying in to listen to this session. So I'll try my best not to disappoint every one of you. So before I start, I hope everyone is been keeping well. Since we are currently going through a tough time with the ongoing COVID as well as the current uncertain times. But please do take care of yourself and do reach out if you need any help. So for today, the key focus of my session will be on ETF, and the topic will be called Do It Yourself with ETF, Personal Portfolio Allocation and Diversification. All right, I think just before I start, probably I give you some of background about myself. So my name is Muhammad Kamal Mustaza. I'm a fund manager of Value Partners, and I joined the firm in April 2019. So it has been about 2 years plus already that I stayed with the firm. Relatively, I think I'm still quite new in the industry with over 9 years of experience in the investment industry. I've been in both the GLICs as well as the non-GLICs with a diverse exposure in managing funds in both conventional and Sharia space with geographic focus ranging from domestic to regional. I graduated from University of Melbourne with a bachelor's degree in commerce, and I'm also a charter holder of CFA, CAIA, FRM, and Chartered Professional in Islamic Finance, as well as the CMSRL license holder. And feel free to connect with me via LinkedIn. I'm more than happy to discuss and chat about any topics ranging from investment to non-investment part. So probably before I proceed, I think I need to give a disclaimer that the content that I'll be using in my presentation will be more skewed towards educational purposes rather than an investment advice. So should you need to seek an investment advice, please go through your licensed fund managers or brokers to get the necessary investment advice. So in terms of the content, let me start off by introducing the company that I work with. So Value Partners is relatively one of the newer kids in town. When I say in town, it means in Malaysia. We established our KL office in 2018, but the firm as a whole has been established for quite some time already. It is one of the Asia's most established asset managers with AUM of $13.1 billion across different asset classes. So our investment approach are filtered towards value investing, and our specialty or expertise are towards Greater China equity. So the firm is listed on Hong Kong Stock Exchange since 2007, and it is headquartered in Hong Kong with office in Shanghai, Shenzhen, KL, Singapore, London, as well as a rep office in Beijing. This is to provide localized research and client servicing. And also, please follow our Facebook page, Value Partners Malaysia, as well as the Twitter page, Value Partners MY, to get more information and insights on what's going on in the investment world currently. Yeah. So this is just to show you the milestone of the company. So the company was founded in February 1993 by fellow Malaysian and fellow Penangites, Datuk Seri Chia Cheng Hai and his partner. With Greater China Equity Strategy as the flagship fund, and since then the company has diverse to go into different asset classes like fixed income, multi-asset, real estate, as well as opening up different office throughout the world. So now we'll be talking about ETF. So let's tackle the 5,000 ringgit question first. So let's say you are given 5,000 ringgit to invest. How then do you proceed? So your options are ranging from a mutual fund, shares, or even ETF. So if you look at mutual funds, it is basically the actively managed that tries to outperform its benchmark by investing in the undervalued securities, market timing, holding concentrated portfolio, and even potentially employing derivatives to enhance its return. So because this is actively managed, funds like this usually command a premium, and this resulted in a higher management fee, and some of them might even charge a performance fee, and they may take on more risk to achieve potentially high returns. But at the same time, I think there's no certainty or guarantee that this fund will actually outperform against the benchmark. So there's always a risk of underperforming the benchmark when you go into this route. So if you like to cut the middleman, you can go directly into buying shares. Uh, so so that you as investors don't really have to pay any management fees. But at the same time, you have the full discretion on deciding what to buy, when to buy, and how much to buy. However, the individual investors may lack the economies of scale. Investors may incur higher costs per transaction, and the ability to diversify is also limited by the investors' available investment capital. So for our example just now, it's about 5,000 ringgit. So I think it's not much if you are looking to buy into individual shares. Then your other option is ETF. So what is actually ETF? ETF is a basket of securities wrapped as a single product that can be bought and sold on the stock exchange. So I think that the picture here, the picture of the basket here it actually tells you the whole thing about ETF. So you can see that in the basket comprised of different stocks, stock A until stock E, and this stock and all these stocks are put in one basket or one financial product, and then it is traded in the stocks exchange. So ETF basically combine the best of both the index funds as well as the individual stocks. So it is similar to the index fund in the sense that it is an open-ended fund scheme. It also tracks a benchmark or index. So because index fund normally track an underlying benchmark, so it normally resulted in a lower expense ratio compared to actively managed funds. And I think similar to index fund, ETF also have high transparency and low turnover due to the fact that it is passive in nature. However, it is also similar to a stock where it is traded on stocks exchange during market hours, whereas the minimum trading unit is one lot, which is 100 units, and the indicative NAVs and real-time prices are available to investors. This is as compared to like a unit trust or mutual fund that are using the forward pricing or delayed pricing for that matter. So how does ETF work? So normally ETF seeks to track the performance of an underlying index. So for example, that we are using here is FBMKLCI. So let's say we go back in time to, I think, 18th of March 2020, when I think the government just announced the implementation of the first MCO. And I think the market was at an all-time low at about 1,200. So you decided that you need to go into the market, but you don't know what to buy. So you decided to go to just buy something that tracks the FBMKLCI benchmark. So fast forward probably like 6 months after that, you can see that FBMKLCI has recovered since the lowest point. I think give a return of about 23%. So let's say, without any need to go into to individual stock analysis, you can actually get the market return by investing into the benchmark itself. So the ETF will then replicate the index based on the index composition. So in this case, the index composition is based on the weightings of the individual securities. So let's say in the FBMKLCI consists of 30 stocks. So the ETF will track or will replicate the index constituent based on the benchmark weights. So let's say public bank is the weight is about 10.5% in the underlying benchmark. So the ETF will try to mimic that as well. So as a result, it will then package into an ETF product, and this is where it bringing the best of both world of stocks and index funds. For example, like a stock, it is trading intraday, so it gives the flexibility to investors, and it is generally liquid. Whereas like an index fund, you have the exposure to benchmark indexes, and you also benefit from the diversification, low cost, and the low turnover. So ETF comes in many shapes and forms. So I think it's up for you to decide what it is. But as I understand, I think on the Malaysian landscape, I think we are still working towards building all this full suite of ETF products. So I think globally we can see that asset type ranging from equity, fixed income, commodity, currency, and even exotic or alternative. and the subcategory is actually more, I think, for equity, we have the broad market like FBM, KLCI. We also have like a sector and even style, such as, I think, a dividend-focused ETF. And I think in recent years, we are seeing more exotic alternative ETF being introduced in the Malaysian market, like the leverage and inverse. I mean, globally, we also have the volatility spreads, long short, global macro. And I think this year there was a cryptocurrency ETF being introduced in the market in Canada, if I'm not mistaken. At the same time, I think there's also an overlay to the ETF, ranging from Sharia, social responsible investing, ESG, or even sustainability. So in terms of the features of ETF, it can range between how the ETF is managed. So on one end, you have the passive investing, and on the other end, you have the active investing. So when we talk about the passive investing, we are basically saying that the ETF is fully tracking the benchmark. So it doesn't really try to add alpha into the performance of the ETF. Whereas for active, normally it divert away from the benchmark index, and it tries to achieve alpha on top of the market return or beta of the return. At the same time, I think the weighting methodology also differs. I think usually normally plain vanilla ETF just follow a market cap weight, but there's also a smart beta ETF that follows the equal weight as well as the fundamental weight. And in terms of the replication strategy, it is ranging from the full replication strategy. This is basically if there's 30 stocks in the benchmark, so the ETF will just buy all the 30 stocks based on the index composition there. But at the same time, there's also a representative sampling that can be used. And to the other end of it is the optimization. So both usually employ different set of mathematical models to ensure that you don't really have to fully replicate the 30 stocks, but rather you just follow you try to match some of the index characteristics like the correlation of the individual stocks to ensure that you can track the performance of the index. So normally ETF is rebalance frequently. So it ranges from the monthly rebalancing, quarterly rebalancing to semi-annual rebalancing. So when you are thinking about buying ETF, some of the factors that you need to consider include the relative performance as well as the cost. At the same time, the portfolio composition and the performance of the ETF itself, as well as the transaction cost and the portfolio turnover that is exhibited by the ETF. So the key features of ETF ranging from, I think the first one is transparency. We know that when you buy into ETF, you actually see what you see is what you get. So there's a full transparency on the constituent information, performance against the benchmark, as well as cost on a frequent basis. So I think for Bursa Malaysia, every ETF issuer needs to upload the basket information daily in the stocks in the exchange website. So I think that is where you can see all the constituents, all the performance, and all the cost information on the ETF. So in a way, you actually know what you are buying into. At the same time, ETF, there's always an abundant source of liquidity, and the liquidity can come from both the secondary market, the one that you see on the on-screen volume that on the Bursa's order book, as well as the liquidity of the underlying asset via the primary market of creation and redemption. I'll touch a bit about this a bit later in the presentation. So yeah. Then in terms of diversification, ETF also offer immediate exposure to a basket or group of securities for diversification through a single trade. So as I mentioned earlier, I think when you buy into ETF, you are not just buying into one single security. You are buying into a different individual securities. So for example, I mentioned before is the FBM KLCI, which consists of 30 stocks. So when you buy ETF that is tracking FBM KLCI, you are basically buying into the ownership of this each of these 30 stocks. Hence, you will get the diversification benefits through just a single trade. And at the same time, I think it is mentioned earlier that ETF have similarities like an index fund, where because due to the nature of it being passively managed, this also leads to a lower management fee versus the mutual funds. And the fact that single basket trade are cheaper than trading on the individual stocks. And I think like ETF, there's no sales charge compared to what is being charged for the mutual funds. So I think there's a lot of cost effectiveness that is coming from the ETF. And last but not least is the flexibility and the accessibility of ETF. It can be traded throughout the day during the market hours. So in terms of pricing, it's very transparent. And also it offers both diversified broad market and niche exposures depending on what you are seeking. This can be done through a single trade. So I think this is a bit too academic, I think, but there's a lot of academic literature that has been stating that asset allocation itself explain about 85 to 95% of the variation in the performance. What does this say? This mean is actually your decision to allocate your money into different asset classes actually are more important than your decision to buy individual stocks. So if you can see from the chart here, we can see that only 5% of the variation in return are coming from the security selection or the market timing, whereas about 90 to 95 are coming from the fact that you allocate into the right asset classes. And at the same time, I think we were talking about ETF can also help you to achieve a diversification benefits. So we know if you buy individual stocks, you are exposed to that particular stock's risk. So I think we already saw in the recent weeks or recent months, there are companies that have issues on ESGs, that have issues on audit. And these issues will actually affect your portfolio if you heavily concentrated into this kind of stocks. But if you buy an ETF, again, using the FBMTLCI, which has 30 stocks, you are basically diversifying away the non-systematic risk or the company-specific risk to the point that you are left only with the market risk. All right, so on this slide, ETF is also one of the key advantages because the ease of use. So ETF can provide an immediate and hassle-free process for foreign exposure. So I think currently in Bursa, you can see that there's a lot of ETF that is traded in ringgit, but the underlying securities are foreign assets. So by having this kind of ETF, you don't really need to open up like a foreign brokerage account to invest overseas, but rather you can do it via Bursa itself. So I think that really helps a lot in terms of making the process easier. And even institutions globally are embracing the ETF. So this is a study made by Greenwich Associates in 2018. So the reason that all these institutions are using ETF is basically similar to what I just mentioned, like easy to use, attractive management fee, liquidity, speed of execution to gain diversified exposure, market access, diversification, transparency, lower trading costs, and avoid the need for single security analysis. So like I said earlier, I think much of the returns are coming from asset allocation rather than a single stock selection. So I think this is one of the reasons why institutions are using ETF as well globally. So now I think we move on to the ETF ecosystem. So on the outside, I think ETF seems like a normal equity or securities that is traded on the stock exchange, but actually behind the scene, there's a lot of effort being done to ensure that the ETF operation can be done to make sure that it is smooth. And there's a lot of key parties actually play part. So I think as a start, we have the fund sponsors or the ETF issuers. So these are the company that actually introduce or create the ETF in the market. And at the same time, they have to work with the index or data providers. So let's say if they are planning to track FBMPLCI, they have to work with a FTSE to get all the constituent information. This is to ensure or help them to actually track the index by minimizing the tracking error. At the same time, I think exchange also play a big part here to again disseminate information. I think like the INEF through the market throughout the day. And there's also the ETF service providers like the custodian, trading platform, or distributors to ensure that the ETF can reach to the wider masses. And last but not least, I think this is quite important as well, the liquidity providers to ensure that the pricing remains efficient, and there's volume being traded in the secondary market as well. So this is a simplified version of the ETF ecosystem that we have right now. We have the primary market, we have the secondary market. So on the secondary market is where you see the ETF being traded on the exchange, where ETF can be traded by investors throughout the market hours. And at the same time, if let's say an investors of a big size coming in and they don't see the volume can be, they don't see that they can get the volume in the market, that is where they go into the primary market to do a creation and redemption of the underlying index. So this is one of the key reasons why ETF is an open-ended fund, because the fund size is quite dynamic. It can increase, it can decrease depending on the demand and supply as well. So when we talk about ETF liquidity, there's always a misconception that ETF liquidity depends on the fund's average trading volume. So if we look at the order book on the Bursa, probably it seems like the liquidity of ETF is a bit low compared to other stocks or equity. But this is where I think it's quite misleading, because the posted volume or the on-screen volume does not really equate to the ETF liquidity. The on-screen liquidity is basically the tip of the iceberg, and there is often significantly deeper markets than what is shown on the screen. So let's say there's an investor that is coming into the market with a big size. So definitely they don't really want to spook the market for fear that it might cause a distortion in the price. So for ETF, this will not happen, because for ETF, we have a dedicated market makers to ensure that the pricing remain efficient. So what I mean by efficient is that the pricing will move in tandem with the underlying fair value of the fund, which is the NAV. So let's say if the size is bigger than what the on-screen volume is showing, then there's always the hidden liquidity. This is basically the inventory that is being held by the market makers, and the inventory can be achieved via OTC platform as well as the securities borrowing. But let's say if the size of buying or selling is much higher than what the market makers can offer, this is where you can go directly into the primary market to do a creation and redemption. So by doing a creation and redemption, you are basically trading on the underlying liquidity. So that's why we always say that an ETF is as liquid as the least liquid constituent in the portfolio, where the onus will be on the ETF issuer like ourselves to ensure that the execution of the creation or redemption can be done well. So these are the two parties that is very important in providing the pricing efficiency in the ETF market. So for the primary market, we have the participating dealer, and for the secondary market, we have the market makers. So normally, the market makers are normally the participating dealer as well. So and the terms being used is quite exchangeable. For simplicity purpose, I will just call them brokers lah. So for the primary market, the participating dealer will transact with the ETF sponsor to help manage the supply and demand on the primary market. So they normally cater for the larger institution that come in a big way. Whereas for the secondary market, this is where the market makers provide the liquidity trading through the market through the bid spread. At the same time, I think if they see an inefficiency in the secondary market, they can also do an arbitrage trading. So how the arbitrage trading can happen? I think, for example, let's say the price of the ETF is trading at RM1, whereas the NAV of the ETF is actually 90 cents. So you have a 10 cents gap there. So what they can do is they buy the ETF on the secondary market, and then they redeem it on the primary market, therefore netting the 10-cent gain in terms of the return. That is where for the arbitrage trading there. So now we go through the ETF landscape. So I think it is very important there's a Malay proverb that says that tak kenal maka tak cinta, right? So I think it's very important for us to understand it, to actually fall in love with it. So I've been in love with ETF for quite some time already. So here we can see that this is the history of ETF. It started in 1993 with the introduction of the first ETF, S&P 500 Depository Receipt, the Spider ETF, that was launched by the State Street. Previously, I think before that, there's already a few iterations that leads to ETF. One of it is the Toronto Index Participation Shares, which was introduced in Canada in 1990. But even then, I think for the first ETF, the groundwork to create this ETF was started in 1990. So you can see between 1990 to 1993, about 3 years for them to actually come up with the first ETF. So it really shows that the journey for ETF is a bumpy one, but I think it's quite worthwhile there. So it takes some time for the ETF to gain traction in the market. We can see that in 1996, the first international ETF was introduced by iShares, where it debuted about 17 international ETF, including the iShares MSCI Malaysia ETF as well, that is traded in US. At the same time, it wasn't until 2002 where we can see that ETF expanded beyond the equity asset classes, where iShares also introduced the first bond ETF, as well as the first ESG ETF. And after that, we can see more new entrants, more new products. The first smart beta ETF, which is the S&P 500 equal weight ETF, as well as the commodity ETF, the Spider Gold. And in 2006, leading up to the GFC, we can see more exotic products being launched, like the first exchange-traded notes, which is like a debt instrument there. And we also see the introduction of the first leverage and inverse ETF, first Sharia ETF, first active ETF, and first volatility ETF up until 2009. So in 2009, we can see that ETF AUM exceed 1 trillion in assets globally, whereas and next year and the year after that in 2010, we can see that US ETF itself hit USD 1 trillion in assets. Then after that, we can see that ETF continued its growth driven by new issuance and new innovative products. With the year to date, I think we can see the asset under management is about 8.9 trillion US dollars. And I think, like I mentioned earlier, I think earlier this year we saw the first cryptocurrency being introduced in Canada. So this is, for me, it's quite exciting to the fact that ETF, it really shows that ETF follows what the current trend that's happening on the market there. So yeah. So now we talk about the ETF landscape in the US. So we know that the bulk of the AUM for ETF is still driven by the US. So in terms of the asset classes for last year, we can see that commodity was showing an increase of AUM by about whopping 64%. I think we can see that largely because commodity prices has been up since mid of last year. So I think that is definitely affect the flow as well. But a bulk of it is still coming on equity. If you can see on the chart on the bottom right there. So now we look at the regional ETF landscape. So Malaysia still lags behind the regional peers, but we are seeing gradual growth in recent years. So right now, we can see that in terms of number of ETF, we have 18 in the market so far. This is compared to 31 in Singapore Exchange and 149 in Hong Kong Exchange. In terms of AUM, the AUM for Malaysian ETF is about 2.1 billion ringgit. This is compared to 28.4 billion ringgit in Singapore Exchange and 449 billion ringgit in Hong Kong Exchange. And the average daily trading, average daily value traded is still small at about 1 billion ringgit versus 70.2 and 3 billion in Hong Kong. But I think if I can direct you in the bottom chart there, we can see that every time there's a new ETF being introduced in the market, we can see there's an increase in the average daily value traded of the ETF. So right now, this is what is the offering that currently we have in the market in Bursa Malaysia right now. So it ranges from different asset classes like bond, equity, and commodity. And also in terms of the subcategory, we have the domestic focus, we have the regional focus, and we have the single country. So right now we have like about 5 Sharia compliant ETF. whereas there's about 4 China-focused ETF. So allow me to verbally mention that our firm is going to launch a Sharia China A-shares ETF next week, and is going to be listed at the end of this month in 28th of July. Yeah. So again, allow me to just verbally mention about the ETF that our firm is going to launch to list at the end of this month. So because it is not launched yet, we cannot give out the full name. So we call it a Sharia China A-shares 100 strategy. So it's going to be an Islamic ETF fund. The launch date is next Monday, where the base currency is ringgit. So the fund objective and strategy is to replicate the Sharia compliant A-shares, which are included in the benchmark in the substantially the same weightings in which they are included in the benchmark. This is in order to track the performance of the benchmark. So the benchmark that we are talking about is the Dow Jones Islamic Market China A-shares 100 Index. Yeah. So like I mentioned earlier, the listing date will be on the 28th of July. So please stay tuned for that. I think it will be quite interesting to look at this space as well. With the initial issue price of 2 ringgit. The participating dealers as well as market makers for our ETF is Kenanga Investment Bank and Melaka Securities. So in terms of the management fee, it is up to 0.6% per annum of the NAV of the funds. And I think trustee fee is about up to 0.06% and index license fee about up to 4 bips per annum. So and on the secondary market, the stock code is 0838PA and the trading currency, like I mentioned, it is in ringgit, and the trading board lot size is 100 units. So why did we came up with this kind of strategy? So there's a 3-pronged approach in the investment strategy that we mentioned. First is the geographic focus, second is the share class, and the third is the thematic consideration. So on the geographic focus, we have China. So we know that China is the second largest economy in the world. So we would like to tap on the growth of China. And at the same time, like I mentioned, Value Partners' expertise is on the Greater China. So we would like to leverage on Value Partners' expertise on this market. And the fact that A-shares remain underrepresented in the global portfolios is one of the key reasons why we believe there is a first mover advantage into the onshore markets. So for the Sharia consideration, we believe that by making it Sharia, we provide access to all groups of investors. And at the same time, due to the quantitative screening of the Sharia methodology, the index composition actually focuses on the new economic drivers. So this is some of the primary that we have for China. So we can see on the left there, we can see that China is on track to become the largest economy in the world. So right now, China is the second behind the US in terms of GDP. And if we look at the projected 4.5% to 5.5% annual growth in the next decade, China's GDP is set to surpass US sometime between 2030 to 2035. So in terms of the long-term outperformance against other markets, we can see that China onshore markets or the A-shares actually outperform against other major indices. And on the far right there, we can see that despite the market cap of about 10.9 trillion US dollars, China's stock market is actually underrepresented with less than 0.22% of global equity fund holdings. So again, this is where we think there's always a first mover advantage into the onshore A-shares market. And again, for A-shares, I think 2019 was a monumental year because we can see there was a big global index inclusion by index providers such as MSCI, FTSE, as well as S&P Dow Jones to add more weights to China. And this provides unprecedented inflows into the A-shares itself. At the same time, A-shares, which has been traditionally a retail market, has seen growing participation from institutions and foreigners. And this is where we believe there's room for the revaluation or re-ratings in the market as well. And last but not least, like I mentioned earlier, due to the function of the Sharia screening, the strategy that we are going to launch is skewed towards the China's new economy with concentration in sector like healthcare, IT, and consumer. And this actually echo the China's 14 5-year plan that they are looking at. focusing on the renewables, green economy, urbanization, consumption, etc. So now to the next part is on the ETF application. So how to build your own portfolio using ETF. So how can ETF benefit you? So it can benefit either the newbie investors or the busy investors. So for newbie investors, you normally don't really have much of investing experience. So normally you don't really come from a finance or investment background, and you're not familiar with tools like fundamental or technical analysis. Whereas for the busy investors, you don't really have the time to monitor your own portfolio, and you normally rely on investment advisors or agents' recommendation to make the investment decision. So I think this is just, I think below we can see that Warren Buffett, the Oracle of Omaha, stating that for most people, the best thing to do is owning the S&P 500 index fund. Basically, what he is saying is that the best way for you to invest is through indexing, or by that, it means that you just buy into a passive fund. And ETF is definitely one of the way to do indexing. So if you like to do things DIY, if you can assemble your own furniture, then you definitely can also construct your own portfolio using ETF. So how to construct your own portfolio? This is where we need to combine the investment objective as well as the constraint together with the capital market expectation. And after that, only then we can proceed with the portfolio construction via different asset allocation methodology. So the first step is basically to try to understand yourself. So there's a few things that you need to do. So I think the first step is to understand the risk. What is your tolerance for uncertainty? You need to understand whether or not you can afford to take the risk. So in terms of the risk measurement, there's two sides of it. One is your ability to take the risk, and one is the willingness to take the risk. So when I talk about the ability to take the risk, I think this is more objective. You can basically determine this based on your disposable income, based on your wealth, based on the time horizon that you have. Whereas for the willingness to take the risk, it's a bit subjective, and it depends on your individual investors' psychology and psyche. So, I mean, normally for the willingness, that is where you take some of the risk questionnaires to determine your willingness to take the risk. And you have to understand that your willingness must match with your ability to take the risk. Otherwise, you can't really get the proper asset allocation that you want. So the next step is to look at the return target. So for investors, what kind of returns that you want? Of course, for in everyone's mind, the higher the returns, the better. But it also have to be to commensurate with the risk that is coming with the higher return. And the return target must be logic, must be practical, must be realistic. So in terms of the return target, it can be either a relative return, where you are thinking to get a return higher than something. And something this, like, let's say if the FBM KLCI is providing a return of about 5%, then you want to have a return 2% higher than the FBM KLCI. So you're looking at a 7% return. Otherwise, you can also have a specific or absolute target return that in mind. Let's say you don't really care about other benchmark, you just want a 7% annually. So that is where we look at the absolute return. At the same time, you also have to look at the constraints there. I think we mentioned a bit about liquidity requirement, whether or not you can afford not to touch your investment due to emergencies. So I think like now we can see that people are going through hardship, due to COVID. So therefore, in terms of liquidity requirement, it might change for different investors. So once the liquidity requirement changes, then the asset allocation will need to be adjusted to reflect these changes in the liquidity requirement. At the same time horizon also plays a part. If let's say if you have a short-term time horizon, let's say you are planning to use the money that you have set aside now in the next 3 months, that means you cannot afford to take a higher risk, and you are more skewed towards something like capital preservation or something very liquid. Whereas if you have a more long-term time horizon, if you're looking at the retirement savings or education fund, this is where you can afford to go into the higher risk investment compared to the short-term one. And last but not least, I think is the unit preference. And this is a bit subjective because it depends on individual beliefs and value system. And this is likely to have a material impact on the composition of the portfolio. And I think one of the, easiest example is Sharia compliant. So if you are a Sharia compliant investors, then you definitely cannot buy into conventional banks, you cannot buy into the SIM sector. And that will actually affect how you allocate your portfolio. So once you in a way understand your risk and return as well as your constraint, the next step is to identify the asset classes and the sub-asset classes that are available on the market. So the two key steps here is basically, I just mentioned here, is to identify what's the current offering that is available on the market. And at the same time, this is where you also need to understand the correlation between different asset classes. On the bottom there, you can see the correlation metrics across different asset classes. So what does it mean by correlation between asset classes? So correlation is basically a measure to test the strength of linear relationship between two quantitative variables. So how does A move in tandem to B? So let's say if A is highly correlated to B, that means they move exactly in tandem with one another. And in this situation, definitely there's no diversification benefits of buying either one of them. You can just buy either one. You don't really have to buy both of them. So let's say for a start, we have the, wait, let me show the pointer. All right. So as start, let's look at the Malaysian equity as the key starting point. This is because I think for local investors, you have more familiarity with the Malaysian economy, with the Malaysian equities, and we definitely have a home bias for the Malaysian equity. And after that, we identify, I think, 5 other asset classes. Let's say global equity, developed equity, US equity, China equity, and gold. So you can see against Malaysia equity, all the other asset classes here have low correlation against Malaysian equity. So, you might think, okay, I can just invest in all 5 of them. But wait a minute, you need to also look at the correlation between different asset classes. What I mean here is basically you have to look at the correlation between global equity and developed equity, global equity and US equity, and the rest of that. So if you look at the first column there, for the global equity, we can see that it is very highly correlated with the developed equity as well as US equity. While I think correlation doesn't actually explain the causality, but we can deduce that basically US equity basically make a large component of the developed equity as well as the global equity, and that is why their correlation is quite strong. So you want to avoid buying into all 3 of them, and rather you just buy just one of them. So let's say, for example, you decide to choose on the US equity. And then the other 2 is China equity and gold equity. We can see the correlation for both of them is very low. So now you already decided on the 4 asset classes that you have. The next step will then be on choosing the asset allocation methodology. So first of all, you need to gather information on the capital market expectation. So this is where you join into investment talks and seminars, you explore the many facets of investing, learn about asset classes, sectors, geographical exposure, what's the current theme currently popular, and the investing style as well. At the same time, I think you can also learn from professional as well as licensed investors. This is by attending investment conferences such as currently that we are doing right now, trainings and events, and read up a lot on how investing techniques are put into practice. And I think last but not least is you can also ask your fund manager or agent, because they normally have access to all the information like fund fact sheets, market outlook, and other information pertaining to the information that you are interested in. Then the next step is choosing the right method that works for you. So the example that I'm using here is more like the informal or heuristic methods, which is not really as opposed to the systematic method. I think this is more on an experience base. So, for example, the 1/n rule. This is basically you simply allocate your capital equally among the n asset classes. So, what does this mean is that if you have already decided on 4 asset classes, like I mentioned previously, the Malaysia equity, US equity, China equity, and gold. So, how much do you allocate for each asset is basically 100% divided by 4. So you have 25% weight for US equity, 25% weight for China equity, 25% weight for Malaysia equity, and 25% weight for the gold. At the same time, I think there's also the 60-40 allocation. This is where you adopt this allocation that consists of about 60% equities and 40% fixed income, or basically the proxy to cash. Or yeah. So in here, equities being, I think, touted as or it's a reflection of the long-term capital growth, whereas fixed income is more towards capital preservation. So this is like a general rule of doing a 60-40 to make, I mean, as a simplified version of it. And I think last but not least, we have the 120 minus your age rule. So let's say you are 30 years old. So by using 120 minus 30, you have 90%. The arithmetic is basically 90, and this reflects the percentage that you will allocate into stocks. What does this mean is that 90% of your allocation are skewed towards equity, whereas the 10% is more on the things like fixed income or cash. So this is age-based change in equity exposure. So the older you get, the lower your equity exposure and the higher your fixed income or cash exposure. So I'm not promoting or I think I'm not promoting any one of this method, but I think for investors, one of the key point here is basically to choose a method that works very well for you, and at the same time to maintain the discipline. When I say the discipline, I think if you have the 1/n rule, then you have to ensure that over time the weight of each asset classes will tend to change depending on the price of the asset, which move over time. So it is important to keep a discipline in order to make sure that the weight remains around the same figure. I mean, if you have like a plus minus 5% buffer, then you allow the asset classes to move plus or minus 5% compared to the 25% weight that you have there. Yeah, I hope I make sense there. Next part, yeah. So this is the resulted, for illustration purpose, this is the resulted asset allocation that you can have. So let's say if you balance, you have a balanced approach. So this is what the allocation for each of the ETF that you have. So you have the ETF Malaysia about 40%, you have ETF for US, which is a proxy to developed market, 30%, and you have ETF for emerging, for China, which is a proxy to emerging markets at about 20%, and the remaining 10% is in gold. Again, please don't take this as an investment advice. I mean, this is just for illustration purpose only, but this is an example of how your asset allocation will look like based on the asset allocation that you choose. And like I said, over time, the weights of each asset classes will change. So it is important that you maintain the discipline to adjust your target weight to ensure that it will not run that far from your target weight. So accessing the ETF, so there's two ways of you to access the ETF. So one of the direct approach is you can take a direct approach. You go to you ask your broker, or you look at the online trading platform to buy into the individual ETF. At the same time, you can also participate into ETF by going through these robo advisory platforms. I think we have a few now in the markets, and these platforms usually have a proprietary algorithm to understand the risk as well, and subsequently allocate your capital based on the risk questionnaires that you mentioned. So in a way, you outsource it to this robo advisory platform. To get the exposure to the ETF. So on this part, like I mentioned, I think in much earlier, ETF is quite transparent. So for each ETF issuer, they normally release release the composition of their ETF in their website as well as the Bursa, as well as in the exchange website. So you can see all the stock that is being bought here, the sector that is being the sector composition as well as the weight of each individual stock. So by doing this, you have more transparency as compared to buying into a mutual fund. So you know what you are buying into in a way. Yep, I think that's all from me. Um, Again, feel free to follow our Facebook group, Value Partners Malaysia, and the Twitter group, Value Partners MY, if you have any other questions or you like to get insights on what's going on in the investment world. Let me look if there's any questions. All right, I think taking some of the question here, the first question is, does an ETF provide entitlements or dividends if we invest in the ETF? So I think, again, it depends on the ETF that you are investing in. They do, some of them do provide dividends on a frequent basis. Especially, I think, if you look at some of the dividend-focused ETF, they do have, they do provide regular dividends. So yeah, that's one of your key consideration. Other questions? I think one of the question is, why do some ETF shows no volume or no update? Is it due to a market close? Again, I think it depends on the efficiency of the market makers or the participating dealers. Because for on the secondary market, the market makers will actually key in the bid ask spread to ensure that there's volume in the market, and they normally try to minimize the spread to ensure that it tracks the NAV of the fund. Yeah. Oh, and this one, quite an interesting question. Does the ETF push a particular index higher? I think for the Malaysia case it's not the case yet. But I think there was some discussion about this, especially on the more developed market, like the US. We can see, like, for the S&P 500, among the top holders of the S&P 500, the ETF issuer like the BlackRock, Vanguard, and I think what else, Invesco. So they do have an impact. But I think the debate is still ongoing whether or not one cause the other. But definitely for Malaysia, that is not the case yet. And I think the next one is, does ETF cause the company in index composition to have higher valuation? Yeah, again, I think this reflects the same question earlier. So which I don't believe it is happening in Malaysia right now. So if I own ETF, am I shareholder of the underlying company? So if we talk about the plain vanilla ETF where they are doing a full replication strategy, by buying into the ETF, you are definitely owning a fraction of the underlying. So you can in a way say that you are also a shareholder of the underlying companies. So next question is, will the new ETF provide regular dividend distribution or purely on growth? So I assume you are talking, when you say new ETF, you are talking about the ETF that our company is going to launch. So we don't really have any dividend distribution policy. This is because the fund is, like I said, because it is skewed towards the new economic drivers. So first of all, the dividend from the index is very minimal, and we would like to reinvest the dividend into the ETF. This is to ensure that the tracking error is also minimized. Is there an ETF in Malaysia similar to S&P 500 or ETF that invests in the US? I think probably not S&P 500, but we have one, the Dow Jones Islamic Titans US, that invests in the US, but it's traded in ringgit, if I'm not mistaken. There's a question on, do the investors inflow and outflow actually affect the fund's liquidity? So because the nature of the ETF that is trading on the secondary market as well as the primary market, I believe that there's no effect on the fund's liquidity. So in a way, investors will not be affected I mean, the current investors will not be affected if, let's say, there's a big investors that actually make a big redemption from the ETF. So yeah, that's not an issue there. There's a question on, how do we make a profit using ETF? Is it by price increase of the unit or through accrued dividend issued? So again, I think it's very important to understand the features of each of the ETF. So some of them with the dividend focus, so that is where you can get the profit from the dividend. But I think some like us, with no dividend being issued on a regular basis, that is where we look on a long-term capital growth there. So yeah, that's how you try to treat on the ETF. So yeah, I think that's all the question that we have. I would like to thank everyone for joining the session. Again, feel free to connect with me in LinkedIn or follow our Facebook and Twitter page. Enjoy the rest of your session. Thank you.